Hey everybody, it's your long lost host, Chuck Barone here on Tuesday, August the 8th, 2023. It's good to be back, guys. I gotta tell you, we've had a little bit of issues here with our production and making some changes to that. So we've been missing some days here. I really apologize for that. I know that a lot of you guys tuning in every day, hoping to see my smiling face and hear a few words of wisdom. Anyway, I apologize, but we're getting it tightened up. We're going to be back now every day. Apologize for the ear pods on as well. As we're changing out some equipment, these are serving as my de facto microphone until I get one that works. Anyway, let's talk about these markets today. But before we do, first of all, let me welcome everybody to the show. Thank you guys for your support as always. What you guys do for us every day here, showing up, watching these videos, your likes and comments, even your critiques, keeps us going here. It means the world to us, guys. Don't give up on us. This show's about to get a whole bunch better. All right, so let's talk about these markets today. Stock market today, not a happy day for stocks. Not an explosive day by any means, but the market all going down pretty much across the board here. You got the Dow dropping 158 points today, 35,314. The S&P, which is the broader market, down 19 points today, 44.99, just under the 4,500 number. The NASDAQ down 110 points, 13,884. I think the market a little bit negged out today on this Moody's downgrading of regional banks. You still got these inflation pressures. You got political insanity. You got wars. You got all kind of stuff for the market to worry about. All kind of new data coming regarding consumer debt and all kind of fun stuff coming up later this week, enough to give the market a little bit of the willies where the market sells off today. So there we have it. Again, the market down, but certainly not in any kind of dramatic way, just a normal day on Wall Street. Bonds today, choppy market, mixed results. The 10-year falling 5 basis points down to 4.3%. The 10-year, or the 2-year, the 2-year actually sitting unchanged, 4.76%. So now you got about a 50 basis point spread between these inverted yields. Starting to narrow down here. Is this going to be where the yield curve kind of gets straightened back out in normal, where the 10-year climbs and the 2-year kind of stops? We'll see. In a normal bond market, if you have a 2-year with a yield at 4.76, typically your 10-year is probably going to be 5.5 range, maybe even more. So we'll see if this bond, how this yield curve works. It's been inverted for about almost 18 months now, I guess, and been signaling recession, which we have not got. But this yield curve, if it straightens out and becomes, gets inverted gets back to normal, where the shorter term rates are lower than the longer term rates, we could see longer term rates really spike up. Dollar today up small, sitting at 102.54 on the index. Dollar still king of the hill right now. No real other currencies challenging the dollar much. Strong number for the dollar, of course, means not great numbers for gold and silver today. Metals down. Gold down $11.70, $1,924.70 per ounce. Silver falling 38 cents, $22.83 for an ounce of silver. So metals kind of going in the wrong direction these days, folks, but still good, strong numbers. Don't get me wrong, but I would like to see gold getting closer back up to that 2,000 number. It will get there and eventually pass through. Silver, we need to get to $25 on silver. This is a number that's really lagging. I'm surprised silver declining at all right now, since it's still pretty inexpensive. But tough day for the markets, and they're always going to respond this way when the dollar has a strong showing. Oil today, still high, man, up 84 cents today, sitting $82.78. Been out of its trough now for about a week or so. So we're going to keep an eye on this and see if we need to reprice oil. I still feel like really the trend in oil is still down more than up. There's not really a lot of data that I'm seeing that's supporting this real spike here. It was down, it was trading between 70 and 75 for the most part for about a year or so. And now looks like it's going to break out of that trough. We'll be setting some new numbers, but we'll follow it for the next week or two and see how it goes. Bitcoin today up, nice day for Bitcoin, up $873, sitting at $29,979, just under that $30,000 number. Seems like Bitcoin is getting more and more comfortable at these levels, which is certainly a good thing for people holding Bitcoin. All right, so let's talk about the markets today. News you guys need. The big news of the day, of course, what spooked these markets today. Moody's coming in today, downgrading 10 regional banks. M&T, some big banks in the mix, bigger regional banks at least. Real estate, commercial real estate, of course, the big culprit. Collapse in their collateral prices, with rates going up and the treasuries they're holding declining in value. Regional banks now got more troubles than they already had. Perfect. Now this follows Fitch last week downgrading U.S. government debt. This is foreshadowing big stuff coming, guys. I don't know exactly how it's going to play out yet, but we're going to watch this. The idea of downgrades on debt, banks, the government, soon probably corporate debt. This is foreshadowing another spike in rates because poorer credit costs more to borrow money. So when your level, it's like say you're a 700 FICO consumer borrower and your credit takes a hit, now you're a 640 FICO consumer borrower. Well, guess what? Money is going to be more expensive if you can borrow it. And of course, it's going to be more difficult to borrow as well. So big trouble coming here in the U.S. We'll see if this is a contagion now or it's going to be limited to these regional banks. I'm sure the bigs, JP Morgan and all their friends, kind of licking their chops now because they're going to come in and swoop up all the valuable assets these commercial banks are holding if there's a collapse. And of course, Uncle Sam and us, the taxpayers, will get left with the scraps they leave behind. So it's going to be fascinating. Of course, we're going to watch this for you guys and bring you up to date as the data comes in. Also today, more bad news, man, just crap every day it seems like. Consumer debt today, reading today about consumer debt, rising $17.8 billion in June. Consumer debt now sitting almost $5 trillion. That's with a T, $5 trillion. Now the bulk of this is in mortgages and student loans. Finally, actually surprisingly, consumer debt, credit card debt actually declined in June. The first decline in credit card debt since April of 2021. But this is just more bad news for the economy here. Consumers needing to borrow to keep themselves afloat. Houses, of course, being more expensive and costing more to borrow, piling on to this debt load. Economists had expected 11 billion. So when it comes in at almost 18, that's a pretty big miss there, guys, right? So it's going to be fascinating to see because we've seen wages increasing a little bit for most workers. For a long time lagging the inflation rate, but for a short time now, the last few months, been higher than the rate of inflation. I certainly don't think those increases, though, are going to be enough to cover 17 billion just in June, guys. Consumers, man. And I hope that the people watching this show are not a big part of those debtors, because we've been preaching since day one not to take on new debt if you can possibly help it. And if you have existing debt to pay that debt down, it's a different kind of life when you owe money than it is when you don't. And I'm telling you guys, not owing, not having big debt to service every single month is going to increase the quality of your life in ways you can't even imagine. You're going to have the freedom. You're going to have flexibility. You're going to have a peace of mind to know that unlike about almost 70% of our population now, you're not living paycheck to paycheck, waiting till next Friday to fill your tank, man. Debt has somehow been made something that's not bad. You know, when I was growing up, being brought up, especially my grandparents, survivors of the Great Depression, man, their attitude on debt was do not have it, and if you do, get rid of it as soon as you can at all costs, to the sacrifice of everything else in your life. Somehow or another, they managed to convince people that debt is good, that debt is okay, that, you know, borrowing now to satisfy these impulses, you know, instant gratification impulses, is somehow better than actually saving the money and buying it for cash. Well, guys, you don't have to be a Rhodes Scholar to see that that is an idea that's just, let's just say it's not accurate, right? For lack of a better phrase. Not having debt is certainly going to afford you a much better lifestyle than having debt will. Now, don't get me wrong, I'm not bashing mortgage debt. Most people can't afford to pay cash for a house, okay? So when you have a debt like mortgage, where it's collateralized by an asset you own, that's actually appreciating in value, and that sooner or later you will own outright, that's significantly different than going and buying, you know, a fancy suit at the department store on your Visa card, and now you're $1,000 in debt, and that suit, I promise you guys, if you try to sell it, you're not getting $1,000 for it, and the first time you wear it, it's worth significantly less than $1,000. Can't use it as collateral for that loan. You're not going to turn, you know, they're not going to foreclose on your suit, right? So it's a different kind of debt altogether. And anybody that wants to make the comparison that they're the same and somehow consumer debt to gratify impulses is a good thing, they're lying to you, okay? And last, before we wrap it up today, you know, we've had the parade of Fed yo-yos out again. The usual suspects talking about more rate increases coming, keeping rates higher for longer. This is something that, you know, we've been hearing from the Fed pretty continuously since they started this cycle. But now, you know, with Wall Street kind of on the fence between, are they done? Are they going to raise again? You know, the economic news keeps coming in hot. I'm telling you guys, and I've been saying it all along, I really believe there's at least one more hike coming this year, most likely next month in September. They're still going to have two more open market committee meetings this year after September, though. We'll see how the economic news plays out, and if that could lead to even two more hikes this year. Now, the Fed target, we already knew at the beginning of the year, they told us, and they've been doing a good job telling us their targets, sticking to their guns. Most Fed economists, Fed governors, said interest rates at the end of the year would be 5.6. Well, guess what, kids? Another quarter point increase puts the Fed funds rate, guess where? 5.6. So I'm guessing, well, this is an educated guess for sure, that we're going to get that next rate increase coming up in September. And we'll see then, following that increase, how the market digests it and where the economy goes from there. Anyway, guys, it's good to be back. Again, I apologize for all the weirdness and the hassles with the channel. We're getting everything in order. I'm looking forward to bringing you guys this show every day. You guys are important to me, man. I'll be back tomorrow to bring you guys the news you need. We're going to start getting big data tomorrow, Thursday and Friday. We'll be here to tell you all about it. Until then, guys, take care. Thanks.